Welcome back to the Capital Exchange. Travis and I saw a stat this week that made us do a double take. A new Betterment survey found that more than half of Gen Z investors that they surveyed, which 52%, said they're redirecting money they otherwise would have to investing to sports betting. That's great.
Yeah,
that's
not a
good
stat
path.
I like to see.
That's a great path.
Maybe even more surprising, Steve. About 1 in 4, I think it said 26%, said they actually view sports betting as part of their long-term financial strategy.
That's a phrase. That phrase is what gets me. Long-term financial strategy.
Yep.
I didn't know that betting was long-term, but because entertainment's one thing, and going to the bar with your buddies and putting $20 down on a game, that's great, but sports betting in the same mental bucket as long-term investing, there's just something wrong with that, and it's not good for your financial future.
No, it's not. And I think what's happening here, Steve, is the line between investing and gambling continues to blur. Everything's on your phone now, right?
It is.
You can open an investing app, a sports book, a crypto platform, and even a prediction market. What is it, Kalshi?
Kalshi, I think that's a great one.
You can have that up on your phone in seconds. They all have charts, alerts, instant transactions, and that feeling, or that same feeling that you need to take action now, which doesn't always translate to profits.
Robinhood's good at that too.
Yeah, they ping you.
Yes.
Yep.
Make it a sense of urgency. But economically, they're very different, obviously. With long-term investing, you're buying ownership in a business, and then you're participating in the growth of that business. With sports betting, the house is taking a cut, and then the odds are intentionally structured against you over time. So long-term, there's nothing long-term about betting.
Well, there's a reason those casinos on the Strip in Vegas are so big. They're not designed to lose money,
That's
right?
so true.
Yeah, and I don't think we should turn this into just like a what's wrong with Gen Z,
agree.
conversation. There's a bigger story here. Other research shows that a lot of younger Americans feel financially behind, right? Housing's expensive, education's expensive, as you and I know, writing those checks to the universities, right?
Yeah, I sent my last one this week, so
so it's double for you now, right? Yeah. So they watch markets, crypto and meme stocks, create overnight winners here recently, and they want to be part of that. So taking a big swing, could start to feel more attractive than waiting 30 years or waiting 40 years to let compounding do its work, even though you and I know that, compounding's magic is hard to beat.
It really is, and it does a lot of the heavy lifting, and that's right, Travis. Another survey recently found that 80% of Gen Z respondents who felt financially behind believed that they need to take higher risk or be in speculative investments to help them reach their goals rather than just taking the traditional methods that we help our clients with every day.
Yeah, and the problem is that feeling, of being behind can cause you to make decisions that can put you even further behind, right? Because compounding works both ways, on the way up, and bad decisions compound on the way down, right? So let's use a simple example here. Let's say you have $100 a month extra available to do something with in your paycheck. Sports betting gives you the possibility of a quick win tonight.
Right.
Or a quick loss tonight, depending on what's going on. But investing, that $100 might feel boring because nothing happens tomorrow. So you can see the allure of the betting, right? But if you invest $100 every month for 40 years, and let's say you average a 7% return on that, you're talking about roughly like $250,000 at the end of that, right?
That's great.
I mean, you don't want to fast forward to 40 years, but if you let compounding do its work, like you said, it does a lot of the heavy lifting for you.
It really does. And most of that isn't even the money that you actually put in, it's the compounding of it.
Yeah.
Which is great.
Which is why the lesson here isn't that nobody should ever place a bet, but it's about, labeling or bucketing your dollars correctly, right?
Yeah, it's about entertainment. It's really, truly about entertainment.
Well, entertainment money, that's your fund budget, right?
It's all right. That's exactly right.
So retirement money investment money, emergency savings. Those dollars have a job, and you probably don't want to ask them to cover the spread on Sunday afternoon. Please don't ask them to cover the spread on Sunday afternoon.
I like that. I like that a lot because building wealth usually it isn't exciting. It's about consistency and time in the market, not timing the market. I mean, it's investing isn't always sexy. I mean, it just
but boring. I mean, boring can work, Steve. I mean, I said this quote before, but Jeff Bezos asked Warren Buffett, hey, obviously what you're doing is successful. Why don't more people copy you? And Buffett's response was, because nobody wants to get rich slow.
That's right. Yeah.
And
they want it all right now.
They want it all right now. Yeah.
And your financial plan probably shouldn't depend on whether the Vikings are going to cover on a Sunday.
Especially the Vikings. Should not depend on the Vikings covering.
Just not good. But that's all right. That's the Capital Exchange. We'll see you next week.
See you next week, Steve.
You bet.